Well, it's a very, very quiet trading session, you'd have to say, but it's all about the banks. They're the leaders of the market, and even if you look at the contribution plate and you pull it up, we have almost now about 50 points coming in just from ICICI Bank and Axis Bank along with SBI. Of course, the market has lost a lot of ground from the top, so it's given up a lot of its gains. But whatever limited gains there are today, it's coming courtesy the banks.
Absolutely, Sonia. You said it is a quiet day. Let's call it a quiet before the storm, perhaps, because we have a lot of cues to work with in the latter half of this week. Tomorrow is the F&O expiry. We also have commentary coming in from the Fed tonight. And day after is the big budget. We'll keep an eye out on individual stories, but like Sonia pointed out, the Nifty Bank, that is racing away to the high point of the day right now, and majority of those gains coming in courtesy Axis Bank, which is also the top Nifty gainer today on the back of a strong set of third quarter numbers. Net interest income growth came in at 18.5%. That's the highest in the last 10 quarters. Abhishek joins in with a roundup. Abhishek.
Well, it's a strong beat actually from top line to bottom line. So if you look at the net interest income growth, it's the highest in last 10 quarters. And for the first time in 10 quarters, it has grown above 18% level. So the loan book growth also remains strong. Last quarter Q2, the loan growth was at 11.2%. It has improved to 12.8, 12.9%, driven largely by domestic loan growth being at 18%. So the net interest margin on account of healthy loan growth is at 3.47%, which is the highest in last 6 quarters. You look at the asset quality, the slippages have increased 35% quarter on quarter, but they are largely driven by the BB and lower rated book, and even it is below the street estimation of 4,800 to 5,000 crore. The gross NPA as a resultant has improved to 5.75 versus 5.96 in the previous quarter, and the management has given a strong guidance in terms of improving their return on equity in the medium term, that is over the next 2 to 3 years, to 18% from 7.3% in 9-month FY19, and that will be driven by risk normalization, business mix optimization, and improving their operating efficiency. So I have about 7 to 8 brokerages, out of which mostly all of them have a buy call, with actually Credit Suisse upgrading the stock to outperform versus neutral earlier, and 4 of them have raised the target price from the previous target price. Back to you.
Okay, thanks a lot for that, Abhishek. We'll come back to you though for more on what to expect from ICICI Bank later today. But Godrej Consumers is under pressure, now down more than 6%, reacting to what was a weak set of numbers. I think it was the volume growth which was a shocker this time, Mangra.
Absolutely, Sonia. Volume growth coming in at 1%, and the street was working with a number of about 5 to 7%. And for a stock like this, which trades at 40 times plus 1 year forward earnings, there was no room for error, especially in light of the results coming in from HUL. Remember, HUL on a high base did a volume growth of about 10%. So on that, 1% volume growth is something that the street did not like. Across the segments, the soaps business grew at about 2%. The street was working with numbers of 7 to 8%. Hair colors, household insecticides, absolutely flat. International business was the only one which was in line with street expectations of 10% growth. So overall revenue growth of 3.5%, EBITDA growth of just 3.3 odd percent, and a net profit decline of about 1.5% is something that did not go down well with the street. Will be very important to know what happens going forward, primarily because the management sounded fairly upbeat. CLSA has cut their target price on the stock, saying the management has plans to revive growth, but that may take some time, and they do not see any hurry to chase the stock at this level. So they've cut their target price from 835 to 800. But let's listen to what the management had to say to us earlier. They said this 1% is a blip, needs to be looked at on a year-on-year basis in terms of 2-year CAGR, and going forward in the next quarter and the next year, they're aiming for double-digit volume growth.
I think the volume growth numbers for the quarter were a temporary blip, largely driven by the high base quarter. And I think our recommendation would be to take a look at this on a 2-year CAGR basis, because the base quarter has a lot of noise driven by GST rate changes that impacted different players differently. So on a 2-year CAGR basis, the volume growth for the quarter was 10%. That is very consistent with the kind of strong volume growth we have delivered in quarter 1 and quarter 3. So for the 9 months, the volume growth is 10%, and our expectation would be to maintain and improve and drive to double-digit volume growth in quarter 4 as well.
Okay, well, I don't know if the street is convinced with that because the stock has not recovered, but they are expecting a double-digit volume growth in Q4. However, for the market, don't lose sight of what's happening with the NBFC stocks. Indiabulls Housing is now down over 5%. It's not so much price action, but volume action, which is quite disconcerting. DHFL is down over 5%, and both these stocks, Indiabulls Housing and DHFL, are now down about 25 to 35% in this month alone. So that's really been a problem pocket for the market. But with just 2 days to go for the budget, sources tell CNBC TV18 that government information officials have been briefed on using General Budget 2019-20 instead of the convention that is interim budget. So could it be a full-fledged budget? CNBC TV18 is still awaiting a confirmation from the Finance Ministry. Remember, just a few days ago, speaking to Shireen Bhan during the India Business Leadership Awards, Arun Jaitley said that a deviation from normal is possible under extraordinary circumstances. Listen in.
It entirely depends on what the existing situations are. And if we look at the big picture, there have been successes that we've seen in the last few years. There have also been challenges. And therefore, without getting into the specifics, because that would really be disclosing the mind into which we are working, some of those challenges really can't afford to wait. And therefore, obviously, there would be a necessity to address some of them. It's happened in the past, and therefore, we intend working within the parameters of the conventions as they exist. Last year was an unusual situation where we had the GST revenue only for 11 months, and we had to really make the expenditure for the full 12 months. And therefore, from 3.5, I intended coming down to 3.3 last year itself, but because of a 1 month absence of a tax revenue of the GST, we couldn't afford to do that. So that was an exceptional situation, which I am sure the markets also understand. And therefore, I certainly do understand the importance. And of course, deviations are possible only if extraordinary circumstances exist. And those are extraordinary circumstances which for analysts, for global players, for domestic players are relatively easier to understand. The farm sector, from the very data itself as it indicates, has been facing challenges. Now the challenges are of a nature that our farmers have hugely increased productivity, and we've moved into a surplus era. Now that surplus era and the management of that surplus is constituting a broad challenge for us for the last several years. The prices have fallen. Even today, if you look at the last few months, food prices is something which have actually gone down in India, and that reflects on the kind of money that the farmers get.
All right, we're getting in numbers from Jubilant Foodworks, 929 crore on the top line, which implies a growth rate upwards of 14%. This what the street was expecting. We're seeing an up move on the stock, and the net profit also is better than what the street estimates were. Net profit is close to around 96-97 crores, and this compares with a poll of 85 crores. So there's a beat of about 10-12 crores coming in on the bottom line. Trying to calculate the EBITDA, that one should come up for you as well. Okay, EBITDA is also a beat of around 10.6 crores. So it's a top-down beat as far as the numbers are concerned. 20 crores higher than the poll as far as the revenue is concerned, 10 crores higher than the poll on the EBITDA as well, which has percolated down to the bottom line as well. More importantly, for Jubilant Foodworks, the stock is moving higher, but we'll have to wait by for the same store sales growth. We were working with a number of about 13 to 14%. That usually comes about 15 minutes from the initial release that they sent to the exchanges. So that is something that the street will await. The stock is moving higher, but maybe it will await the same store sales growth. But reported numbers look better than estimates.
Oh, they do, right? I mean, it's almost a 17% growth that you're seeing on the top line. This compares to about a 21% growth that we saw last quarter. So quarter after quarter, they're delivering quite well. I mean, pun intended there. And of course, you know, we've seen even the operational performance improve for them quite a bit. I mean, this time the EBITDA, as you said, is higher than estimated. What is the EBITDA margin number for the quarter? Have you been able to calculate?
I haven't calculated the EBITDA margin, though. It would be any different in terms terms of what the poll was, because we had a beat on both the revenue as well as the bottom line and the EBITDA by about 10-20 crores. So the margins would be pretty much in line with what the street is working with. However, what I'm looking at is the rent as percentage of sales. That one's come in at 9.3%, and this compares with 10% quarter on quarter. And the previous 3 quarters, it has been 9.4 and 9.8. So what the company is basically doing is they are shutting unviable stores. They are renegotiating rent contracts with existing landlords, and that is also aiding their EBITDA more along with the sort of delivery that they've been doing. So store expansion is also something that I'll be watching out for in the press release. 20 to 23 stores is what the street is working with regards to Domino's opening, and Dunkin' Donuts is something that we'll be watching out for as well, because the management had guided for that to be operationally positive by the end of this year. Has that happened now, or will that happen in the next quarter, is something we'll be watching out for.
I think what the street is also reacting to is this 18% margin, and that is better than what they did last quarter, right? Last quarter it was, I think, 16.7%. This quarter it's come in at 18%. So sequentially, the quarter after quarter, the margins are improving. I think that's where the next leg up has come in from, just in the last 5 or 10 odd minutes. And remember, the stock does have some leg room. It has come off, I think, what Mangalam was telling us, about 25% from the highs.
It has come off from come off about 25% from the highs. I'm also trying to look at the employee expenditure. Okay, quarter on quarter there hasn't been much increase in the employee expenditure. It's 177 crores. This compares with about 170 crores. Now, why is this important? Because towards the end of the last quarter, the management had said that they had seen some competition ramp up from online food distributors. What this does is that it increases the cost of delivery manpower. So this was an important monitorable to see whether employee expenditure has gone up quarter on quarter or not, because after the previous quarter we have Swiggy getting some more money from the venture capitalists. So are they going all out aggressively, getting more manpower that makes cost control difficult for Jubilant Foods or not? It was the big question, but seems like employee benefit expenses have also been curtailed so far. About 177 crores. This compares with 170 crores quarter on quarter.
Okay, so all in all, in case you've joined in late, more pizzas being eaten, and of course they're shutting down a lot of their non-profitable stores. So they're saving on rent. Perhaps that's also aiding to margins this time. Very good numbers, a beat on almost all fronts for them. I think the margin performance at 18% plus is the standout performance. But we're still waiting by for what the same store sales growth number is. Generally, that moves the stock as well. For now, these are the numbers that we have. Good numbers coming in from Jubilant Foods. Anything else that you'd want to mention?
Nothing else. In fact, this is we pretty much. I am hungry after that. So what we'll do is we'll take a short break, a short quick hunger break. Come back. We talk about ICICI Bank. That one's also on our radar ahead of earnings.
Okay, just before that, we do have the same store sales growth numbers.
All right, 14.6%, which is
a poll of 12 to 13%. So that's better than expected.
That's better than expectations. Yes, so that is a positive as well. So 14.6% in terms of same store sales growth. Though the whisper number was a little more. So let's see how the stock reacts to that. But remember, 14.6% is upwards of what the street was working with, and that in congruence with the sort of results that the company's posted is what is taking the stock higher, up about 2.5% right now.
Also, want to talk about the 35 stores that have opened this time.
That is a positive. 35 stores that they've opened is a positive. Why? Because one, the street was working with 20 to 23, so they've increased their stores, and with an increasing number of stores, they've increased the same store sales growth. And while all of this is increasing, the costs are curtailed because rent as a percentage of sales has fallen quarter on quarter by about 70 basis points. So looks like all things firing right now. How much of it is baked in the price, if you must, is the big question to ask, because even at current levels, the stock trades at 42 times 1 year forward earnings, assuming 100% EPS growth.
There's actually nothing to complain in these numbers at all. It's the highest EBITDA margin in the last 7 years that the company has clocked in, going by their own press release, at about 18.4% EBITDA margins. They also speak about how Dunkin' Donuts has reported a break-even performance this time around, and that milestone has been achieved ahead of the stated guidance of Q4. So, that is another big positive.
That is the big positive. So while the numbers were there, that was something that one was wondering whether Dunkin' Donuts has gone ahead and achieved its break-even ahead of the expectation. The management over the last 3 quarters had guided break-even by the end of this year. It seems to have come about in this quarter itself. That means the next quarter, there are legs for either some growth or no further losses. So that would get the analysts to tweak their estimates. So we'll await brokerage commentary and earnings call as well, but 35 Domino's store addition, more stores added with more same-store sales growth, less rent spent, and the loss-making business now breaking even. All of this, coupled with the fact that the stock is off its highs, is adding to the taste of that pizza.
Oh, absolutely, and pretty
hefty one. Cheese burst, if you must.
That, yeah. Okay, so very good numbers coming in, ticking all the right boxes. Actually, nothing to fault in these numbers at all. Break even for Dunkin' Donuts, strong growth in the core portfolio for the business, and margins have picked up, highest EBITDA margins in the last 7 years.